Intel is down 53% year to date, but after reporting dismal 2Q results and hitting a 52-week low of 1851 in early September, the stock is up over 21% in under 2 months. So, is this turnaround to avoid, or could this be the buying opportunity of a lifetime in this American icon? Let's dive in and find out. All right, 4 points that we're going to cover in today's video. Number 1, background/business model. Intel is known for creating the world's first microprocessor in 1971, which revolutionized computing by allowing multiple functions on a single chip. Today, Intel is one of the largest chip makers in the semiconductor industry and the world leader for CPUs in PCs and servers. Part 2, the opportunity, positives and negatives. While Intel is a household name and the world leader for personal computing microchips, it is falling behind AMD, Taiwan Semiconductor, and NVIDIA in AI chips and GPUs. Key partnerships and a recently approved $7.9 billion government grant from the CHIPS Act provide hope that Intel will regain its footing, and I cover all of this in detail. Part 3, company updates. So 3Q24 results, the status of the turnaround, and the unexpected retirement of CEO Pat Gelsinger. I'm going to cover all of these in detail and share what it means for investors. Part 4, valuation. On Wall Street, we build 3-statement financial models culminating in a discounted cash flow or DCF valuation. I have built a 3-statement model with a DCF for Intel, and I can't wait to give you all the details. So let's dive right in. If you're enjoying this, please smash that like button. Do you want to build wealth and have a proven system to pick winners and avoid losers?
No, that's not all. I want to be rich.
Investing success requires discipline, the skill of investment analysis, and the techniques that are proven. Some of the world's largest asset managers and investment banks pay me thousands of dollars a day to train their analysts. But what if you could have access to that knowledge for just a fraction of the cost?
Sounds good to me.
That is exactly why I created the Win Like Wall Street community, to give regular folks like you and me the tools and cutting-edge strategies to build wealth consistently and predictably. Don't wait. Right now, go to bit.ly/WLWS to join my exclusive community, Win Like Wall Street, where you can get the same Wall Street knowledge as the world's largest financial services firms, my Excel models, and direct access to me. See you on the inside. All right, part 1, background/business model. Robert Noyce and Gordon Moore, 2 engineers and inventors, founded Intel in 1968. The company is headquartered in Santa Clara, California, in the heart of Silicon Valley. In the company's own words, we are an industry leader and a catalyst for technology innovation and products that revolutionize the way that we live. Commitment to harness the breadth and scale of our reach to have a positive effect on business, society, and the planet. Purpose: to create world-changing technology that improves the life of every person on the planet. Intel expanded its product line to include memory chips and microcontrollers, solidifying its position in the tech industry. Market leadership. By the 1990s, Intel became a leading supplier of microprocessors for personal computers, with its Intel Inside campaign boosting brand recognition. Continued innovation. Intel has consistently invested in research and development, contributing to advancements in artificial intelligence, 5G technology, and autonomous vehicles. So how do they make money? Intel operates its business through 5 operating segments. 54% of revenues come from Client Computing Group. This group is responsible for Intel's core business of providing processors and related technologies for personal computers and laptops. It includes the development and sales of microprocessors, chipsets, and other components used in desktop and notebook computers. Customers include Dell, 19% of revenues, Lenovo, 11% of revenues, and HP, 10% of revenues. Data center and AI, this is 29% of revenues. This area focuses on delivering high-performance products and solutions for data centers, cloud computing, and artificial intelligence applications. This segment includes Intel Xeon processors, which power servers and enterprise data centers, as well as solutions for AI and machine learning. 11% of revenues, network and edge. This area deals with products and technologies that support network infrastructure, communication systems, and edge computing. This segment includes networking products like Ethernet controllers, network processors, and solutions for 5G and the Internet of Things. 4% of revenues, Mobileye. Intel's autonomous driving and advanced driver assistance systems segment. Say that 5 times fast. It was acquired by Intel in 2017. Mobileye develops computer vision technology and AI algorithms that power self-driving cars and enhance vehicle safety features. 2% of revenues, Intel Foundry Services. So this is Intel's dedicated business unit that offers semiconductor manufacturing services to external customers. This segment focuses on producing chips for other companies utilizing Intel's advanced process technologies. Part 2, the opportunities, positives, and negatives.
What are the positives?
Despite challenges, Intel is making strategic moves to regain its footing. Strategic partnerships. Intel secured a major contract to produce chips for Amazon, signaling confidence in its manufacturing capabilities. Cost reduction initiatives. The company is implementing a $10 billion cost reduction plan to improve operational efficiency. Focus on AI. Intel is investing in artificial intelligence technologies to capture emerging market opportunities. Government support. Intel is set to receive $7.9 billion in grants from the CHIPS Act to boost its domestic manufacturing capabilities. Product innovation. The company continues to develop new products and technologies, aiming to regain its competitive edge in the semiconductor industry. So what's the takeaway? Intel has a rich history of innovation and is actively addressing its challenges to remain a key player in the tech industry.
So what are the negatives?
Competitive pressure. Rivals like AMD and NVIDIA have developed advanced technologies, leading to a loss of market share for Intel. Manufacturing delays. Intel has experienced setbacks in advancing its chip manufacturing processes, causing it to fall behind competitors. Financial struggles. The company reported significant financial losses in recent quarters, affecting investor confidence. Leadership instability. Frequent changes in top management have created uncertainty about the company's strategic direction. Technological lag. Intel has been slow to adapt to emerging technologies like AI, allowing competitors to gain a foothold in these markets. Dividend suspension. In response to financial challenges, including declining sales and increased costs, Intel has announced the suspension of its long-standing dividend in August of 2024. This decision marks a significant shift in Intel's capital return strategy, as the company had maintained regular dividend payments since 1992. The suspension is part of broader measures to conserve cash amid efforts to revitalize the company's operations. Credit downgrade. Intel was downgraded from A- to BBB+ with a negative outlook by S&P Global in mid-September. CEO departure. The unexpected retirement of CEO Pat Gelsinger earlier this week caused the stock to fall 6.1% in response and leaves investors with uncertainty of who is going to lead this difficult turnaround of the company. I'm going to cover this in a ton of detail, so stay tuned. Financial issues. In addition to the credit downgrade and dividend suspension, debt is increasing, margins are decreasing, and free cash flow is negative. I'm going to cover this in plenty of detail in the valuation. In August of 24, Intel engaged investment banks, including Morgan Stanley, to explore strategic alternatives amid financial challenges and increased competition. These advisors were tasked with evaluating options such as splitting or selling business units, particularly the manufacturing division, to enhance shareholder value. Now, while analysts, including those from Bank of America, suggest that Intel may consider separating its manufacturing and design operations, such a move is complicated by conditions attached to the approximately $8 billion they're receiving in the Federal CHIPS Act's funding, which requires Intel to maintain a significant stake in its foundry business. Part 3, company updates. So this is a summary of Intel's Q3 24 results and some key takeaways. Revenue of $13.3 billion was slightly above guidance, but down 6% year over year. GAAP gross margin of 15% was significantly impacted by $15.9 billion in impairment charges. Net income. They showed a GAAP loss of $16.6 billion, driven by restructuring and impairment charges. Operating cash flow came in at $4.1 billion, with adjusted free cash flow at negative $2.7 billion. Deferred tax asset write-off, a $9.9 billion non-cash charge, further impacted financial results. So some key financial metrics: restructuring and impairment charges. They faced $15.9 billion in GAAP charges, including $3.1 billion in manufacturing asset impairments, $2.8 billion in restructuring costs tied to workforce reductions and cost-cutting efforts. So some key takeaways for investors. Progress on the cost reduction plan. Intel is advancing toward its $10 billion cost-cutting goal by 2025. Workforce reduced by over 15% with significant capital expenditures reductions as well. Portfolio simplification includes integrating edge businesses into client computing and narrowing focus in the network and edge group. Product and technology developments. AI and x86 leadership. So continued leadership in AI PCs, with Intel on track to ship over 100 million AI PCs by the end of 2025. launched Lunar Lake and Arrow Lake processors with AI capabilities. Intel Foundry Services. They achieved early milestones for the Intel 18A node. Expected launches in 2025 include Panther Lake client CPUs and Clearwater Forest server CPUs. They secured multi-billion-dollar design wins, including commitments from AWS. Xeon platform. Xeon 6 Granite Rapids processors doubled prior generation performance. Gaudi 3 AI accelerators launched but faced slower than expected adoption. Challenges and headwinds. Restructuring impact. So significant short-term profitability challenges due to restructuring and impairment charges. Competitive pressures. Intel faces intense competition from Taiwan Semiconductor, NVIDIA, and AMD in both manufacturing and product innovation. Strategic restructuring. They announced plans to spin off the Intel Foundry Services as an independent subsidiary to attract external funding and optimize operations. Altera's business is being prepared for a partial sale or IPO. Outlook. Q4 revenue guidance of $13.3 to $14.3 billion, gross margin of 36.5%, EPS guidance of minus 24 cents.
But the boss.
So Pat Gelsinger, Intel CEO and a 40-year veteran of the company, abruptly retired on December 1st. Gelsinger's departure followed concerns raised during a board meeting about his slow progress in turning the company around. Intel CFO David Zinsner and Intel Products CEO Michelle Johnston Holthouse will temporarily lead until a permanent replacement is found. Stock performance. Intel stock fell 61% during Gelsinger's tenure since February 2021, compared to a 54% gain for the S&P 500. The stock has dropped 53% in 2024, setting it on track for its worst year since 1974. Foundry business challenges. Gelsinger launched an ambitious plan to bolster Intel's internal foundry operations as part of its IDM 2.0 strategy. The foundry unit incurred a $7 billion loss in 2023, with expectations of doubling that loss in 2024. Analysts question the viability of Intel's integrated device manufacturer model, citing conflicts of interest with potential foundry customers. Competitor advantage. While Intel struggled, competitors like NVIDIA surged ahead, with NVIDIA's market value now over 30 times that of Intel. NVIDIA and others rely on third-party foundries like Taiwan Semiconductor, whereas Intel's foundry business has failed to gain traction. Potential business split. Analysts at Bank of America anticipate a higher likelihood of Intel splitting its products and foundry businesses, potentially improving operational efficiency. However, Intel must maintain some ownership in the foundry unit to comply with the CHIPS Act funding requirements, which include a $7.9 billion grant awarded last week. Industry and analyst feedback. Gelsinger's departure was seen as partly due to the lack of progress in securing foundry customers and turning the business around. Analysts expressed skepticism that Gelsinger would have left if the business was performing well. So what are the takeaways? Strategic missteps. Gelsinger's IDM 2.0 strategy backfired, leaving Intel with significant financial losses and lagging competitors. Leadership instability. So frequent leadership changes and a lack of clear strategic direction have contributed to Intel's struggles. Urgent need for restructuring. A split between the products and foundry businesses may allow Intel to focus more effectively on core strengths, but this move faces regulatory hurdles tied to government funding. External reliance and competition. Intel's reliance on outsourcing some production to Taiwan Semiconductor highlights its failure to achieve a competitive edge in chip manufacturing. Stock outlook. With ratings such as underperform from Bank of America and hold from Melius Research, analysts remain cautious about Intel's future performance and recommend careful consideration for investors. Intel faces a critical juncture, balancing restructuring efforts, government support conditions, and competitive pressures. Gelsinger's departure underscores the company's ongoing struggles to regain its once dominant position in the semiconductor industry.
It's essential that the turnaround be fast.
So Barron's just awarded Intel with the worst turnaround of 2024 ahead of Stellantis, Boeing, and CVS. That says something. Intel's challenges and failures. So number one, leadership instability. CEO Pat Gelsinger's sudden departure has raised questions about Intel's turnaround strategy. The timing of his exit amid ongoing struggles suggests deep-seated issues in the company. Stock performance. Intel stock has fallen 53% year to date, the steepest decline among high-profile turnaround attempts. Its its market value has shrunk from a peak of over $275 billion in 2020 to approximately $105 billion. Failed turnaround strategy. Intel aimed to revive its business through massive investments in chip manufacturing and new designs. These efforts have led to significant cash burn, with free cash flow plunging from $38 billion in 2020 to a projected loss of $25 billion over 23 and 24. Competitive disadvantage. Intel lags behind AMD and Taiwan Semiconductor in both chip design and manufacturing. It relies on Taiwan Semiconductor for manufacturing its most advanced chips, undermining its competitive edge. AI market miss. While rivals like NVIDIA capitalized on AI's booming demand, Intel's AI chips have seen lackluster sales. Now, this is legit crazy. NVIDIA, which Intel declined to acquire 20 years ago, now holds a market value exceeding $3 trillion. Exposure to declining PC market. Intel's heavy reliance on PCs, a market described as grim by Bank of America, further hampers growth. Smartphone-like processors, a segment Intel exited years ago, threaten to replace traditional PC chips. So what are the takeaways for Intel? A lack of strategic clarity. Intel's struggles highlight a lack of a cohesive strategy to navigate competitive financial and operational challenges. Missed opportunities. Poor past decisions like foregoing NVIDIA's acquisition have compounded its disadvantages. Bleak analyst sentiment. Only 11% of analysts recommended buying Intel stock, reflecting widespread skepticism about its recovery prospects. Intel's turnaround faces daunting challenges, including competitive disadvantages, financial instability, and limited strategic flexibility. As 2024's ugliest turnaround, the company exemplifies the complexity of navigating a tech industry reshaped by rival success and missed opportunities. Part 4, the moment we've all been waiting for, the valuation. We're going to start with the balance sheet. So cash has increased 1.3x over the last 5 years. While this is normally a positive, the source of this increase is debt rather than free cash flow. We'll see this later in the cash flow statement. This is one of the most capital-intensive businesses, and we see a more than 2x increase in PP&E over the last 5 years, from $55 to $114 billion. Debt has almost doubled over the last 5 years, going from $29 to $50 billion, and the company is net debt, meaning debt is greater than cash by about $24 billion. Lastly, we see a downward inflection in retained earnings in 2023. This is because Intel generated $1.7 billion of net income, but paid $3.1 billion of dividends. Now, while the dividend suspension will help, we still project a decrease in retained earnings by $4 billion at the end of our model. So what's the takeaway? This is a capital-intensive business that is being financed with new debt rather than retained earnings and operating cash flow. The increase in leverage is a bit concerning and something to keep an eye on moving forward. Let's hop in the model. All right, so as we mentioned, we have a 5-year increase of 1.3x of cash, but we have a corollary 2x increase in PP&E. Their debt has increased very significantly, topping $50 billion as of 3Q. In addition, we see the downward inflection of retained earnings, something that is not projected to increase, but rather decrease by $4 billion by the end of our model. Income statement. Over the last 5 years, revenues have declined 27%, going from $72 to $53 billion. Even more concerning is that this is during the AI boom, where NVIDIA's revenues increased almost 6x from 11 to 61 billion in the same time frame. Costs are out of control, with COGS increasing nearly 10% over the last 4 years, resulting in margin compression. Gross margin has gone from almost 60% in 2019 to 40% in 2024. That is a 33% relative decrease and a massive red flag. It only gets worse as we go lower. EBITDA margin has gone from 46 to 9% year to date. That's an 80% relative decrease. Operating margin has gone from positive 31% to negative 31% year to date. Net margin has gone from positive 29% to minus 49% year to date. Now, what's the takeaway? While the company is engaging in headcount reduction and numerous cost-cutting initiatives, it will take time to stop the bleeding. Let's hop in the model. So as we mentioned here, 5-year revenue decline of 27%, while NVIDIA's increased 6x. Insane. If we go further down, we see that they haven't been able to cut costs at the same rate that they've been declining in revenues. We see that EBITDA has been negatively impacted. Same thing with EBIT. The only saving grace in 2023 was the fact that they have so much cash that they're investing that they generated positive interest income to outweigh all of these negatives. And that is really the main reason why they were able to actually generate positive net income in 2023. Next, we have the cash flow statement. Free cash flow has gone from $17 billion in 2019 to minus $16 billion in 2024, a swing of $33 billion, driven primarily by decreasing net income, and secondarily by increasing CapEx, which has gone from $16 billion to $26 billion to keep up with AI development. Since 2020, the company has been a net issuer of debt, meaning they issue more than they pay down. From 2019 to 2023, the company has issued $36.6 billion and repaid $15.1 billion for a net increase of $21.5 billion of debt. While the company had no share repurchases the last 2 years, they did repurchase 904 million shares for $44.6 billion from 2017 to 2021 at an average price of $49.28. Based on yesterday's close of $22.47, that means the company has lost $24.3 billion. Take 49.28 minus 22.47 and multiply that by 904.4. That equals $24 billion of shareholder value destroyed. Pro tip, returning capital to shareholders is a good thing if you don't need to use debt or cut your dividend in the process. This example with Intel is a cautionary tale and a corporate finance nightmare for investors because the $24.3 billion could have sustained the dividend for 4 to 5 more years while management gets the company back on track. So what's the takeaway? Intel's troubles did not happen overnight, and any analyst worth their salt could see the decreasing net income combined with increasing CapEx, an unsustainable dividend, and poor decision-making on the share buybacks years in advance of today. Let's hop in the model. All right, cash flow statement. As we can see, free cash flow is negative, and it's only going to get worse over time with operating cash flow declining. We see that capital expenditures hasn't really slowed down that much to try to keep pace with all the developments in AI. They are a net issuer of debt to the tune of $21.5 billion. Thank God they stopped the share repurchases in 2021, but the damage has already been done. They suspended their dividends a few months ago, so that's why we have 0 in dividends on a going forward basis. But looking forward, what we see is a massive decrease in cash over the next several years. They're going to have a cash outflow on the net of $83.6 billion. Something's got to give with this company. Forecast drivers and DCF assumptions. The company lost 20% in revenues in 2022 and 14% in 2023. 2023 revenues are below what they were 10 years ago. So I could easily justify 0% or negative top line growth. But Wall Street sees recovery in 2025 and a 4-year compound annual growth rate of 8%. So I took a haircut. I went with 4%. Cost of goods sold, research and development, and MG&A were 54% combined in 2019, while today they are 82%, a more than 50% increase. I kept these flat, but reduced MG&A due to headcount reduction and would not change that unless and until we see tangible improvements by the company. Another key driver is CapEx, which is the lifeblood of a semiconductor company. I cut $3 billion off of forward CapEx based on company guidance. For a semiconductor company, they have a reasonable beta of 1.2, which is risky but not high risk. We use a terminal multiple of 3 times LTM revenue. This is in line with the company's average over the last 24 quarters of 3.02x. The current multiple is 2.4x, and we actually boosted or benefited the company where we would normally give a haircut. It's important to note that Intel is well below the comps, but they have been for years, so there's no logic to boost here. Their number one competitor, AMD, trades at 9.4 times TEV to LTM revenues. So what's the takeaway? Conservative assumptions equals conservative results. Let's hop in the model. All right, so as we mentioned first, declining revenues, major red flag here. I ended up keeping costs flat for cost of goods sold and research and development. I did do a reduction on MG&A because that takes into account the headcount reduction. Moving on from there, sales growth for our base case, we went with 4%. The beta of 1.2, again, is high, but not ridiculously high. They did get downgraded by S&P, so they have a BBB plus rating with a negative outlook. Their book value of debt is $1 billion higher than it was at year end. They do have decent amount of cash, about $24.1 billion. So that's something that does help the company. But at the end of the day, they're not getting any benefit from their terminal revenue multiple. Over the last 24 quarters, it's averaged 3.02. All right, DCF valuation, we ran 3 scenarios, bear, base, and bull with the current model at base. Future cash flows are discounted back to today to get to TEV. We strip out net debt to get to equity value. They're a leading player in the CPU microchips for PCs, and they have hit a rough patch of late. Intel is down 53% year to date, and after a 52-week low of $18.51 in early September, the stock is up over 21% in under 2 months. But is it worth buying today? Wall Street has Intel at a median of $25, which is an 11% discount. But what does our analysis show? Let's hop in the model. DCF time. Woo-hoo. So we got EBITDA less DNA gives us EBIT. We strip out the cash taxes. We get EBITDA or NOPAT. We add back the DNA. We have changes in operating working capital. Massive amount of CapEx leads us to negative free cash flow to the firm. We have our 3 times terminal revenues to get our terminal value. We add all of those together. We get our cash flows to discount. We discount them by the discount factors. We get the present value of cash flows. We add those together to get our TEV or total enterprise value. We strip out debt. We add cash. We strip out non-controlling interest. We add associate investments. We get an intrinsic equity value of $62.1 billion divided by the current shares outstanding. We get an implied share price of $14.41 compared to the current close of $22.47. That's a 35.9% premium, which is a definite sell rating. Sensitivity and scenario analysis, we ran 50 different models by utilizing data tables. We sensitized revenue growth versus research and development and weighted average cost of capital versus terminal multiple. 50 out of 50 or 100% showed a sell rating, 0 out of 50 or 0% showed a hold rating, 0 out of 50 or 0% showed a buy rating. We ran each of the 3 scenarios equally weighted. We got a weighted average value of $15, which is a 33% premium. So what's the takeaway? Utilizing conservative assumptions, we show a sell rating for the stock in the bear and base and a hold in the bull case. Let's hop in the model. All right, sensitivity analysis, not much to see here other than a complete bloodbath. The company is not even close to what it's currently trading at, even in an 8% revenue growth scenario based on our current assumptions. Even at a terminal multiple of 3.5 times, which is significantly higher than what they've had over the last 24 quarters, it's not even getting to what the current trading price is. Last but not least, we come to the scenario analysis. We equally weighted the 3 scenarios. I mean, you're talking about 460 in the bear case, 1440 in the base case, and 2587 in the bull case. And that's like the absolute best case scenario. It's still not even a buy in that scenario. We get a weighted average about $15 or a 33% premium. All right, the wrap up. Wall Street has Intel at a high of $26, which is a 38% discount, a median of $25, which is 11% discount, and a low of $20, which is an 11% premium. The stock is down 53% year to date, but it is above its 52-week low from early September and is up 21% over the past 2 months. Now, you should seek the advice of an investment professional always. I do not know your individual financial situation, and this content is meant to educate and is not investment advice. That being said, I personally do not have a position in Intel, and I am thankful that I do not. Unfortunately, I think people have incorrectly associated Intel with the AI revolution, and they are primarily a maker of CPU microchips for PCs. Some people think Intel is ready for a comeback. Really? That's not what the numbers say. This is like you just ran into the hottest, most popular person in high school, and they have been through 5 divorces, gained 50 pounds, and just got out of rehab. And rather than look at what they currently are and run the other way, you are thinking about who they were in high school. Stop thinking about what Intel once was and start thinking about what they currently are. It's not going to turn on a dime. It will take another 2 to 3 years for the current changes to bear fruit. Now, 2025 will be a pivotal year for the company, and until measurable progress is achieved, in my humble opinion, this is a stock to avoid.
Yeah, we'll avoid it at all costs.
The company is loaded with debt, which only seems to increase. It is a very capital-intensive business, and if they pull back too much, they will negatively impact their business, let alone future opportunities. Now, if you like this and want to see another in-depth stock valuation, check out my Celsius model here or my SoundHound AI model here. And if you found this valuable, please share this with someone who you think would enjoy this. And as always, be relentless.